Good morning, everyone. It gives me great pleasure as President to welcome you to the IACT Virtual Treasury Summit 2020. In January, when we were planning this year's annual conference, I didn't think we would be meeting this morning on a virtual platform, but then everything changed in March. It's been a very challenging year for everyone, both professionally and personally. I hope everyone is well and managing to get through 2020 in the best way possible. I'm happy that we've been able to put on our annual conference today, and the conference committee of Keith Lynch, Fiona Hughes, Jason Murphy and Willie O'Dwyer, along with Summit Focus, have put together an excellent program. We have a great mix of topics and speakers that will look at where we have come from during 2020 and what is ahead of us in 2021. I've spoken to many treasurers over the last few months, and we've all managed to work over a prolonged period in a way that we could not have imagined last year, ensuring that our companies are in a position to navigate the economic challenges as a result of this global pandemic. It is now the second time in 10 years that a global crisis has put corporate treasury at the forefront of our companies. This time around, facing those challenges working remotely, relying upon and using technology to connect with our colleagues, both internally and our partners externally. I'm sure our use of technology has been accelerated by a number of years at this stage. I hope you enjoy the presentations and take the opportunity this morning to make it as interactive as possible, putting questions and comments to our panelists and contributors. Our conference sponsors are HSBC, Barclays and JP Morgan. I would now like to hand over to Mark Coleman, who will chair today's conference. Thank you, Mark.
Thank you very much, Kevin, and good morning, everybody. And let me also thank our sponsors, HSBC, Barclays, and JP Morgan, and also Summit Focus and Crowdcoms for putting together what I'm hoping you're going to agree is an excellent lineup today. We have fantastic speakers. We have an expert panel discussion. We have networking sessions with exhibitors and participants, a charity quiz, and the chance to win a €150 prize. But first, let me welcome our first distinguished guest to talk about what next year might have in store. Will you please welcome global economist with HSBC, James Pomeroy. James, the floor is yours.
Fantastic, and thank you very much to everyone for having me. Absolute pleasure to be here and to be talking to you about the global economy, even if it is a shame that it is virtually rather than in person. Now, my presentation is unsurprisingly relatively negative, and on my first slide here, you can see really where the negativity is. So some of the Google mobility data that we can see for Europe in particular have really come off a cliff. And this data is the sort of thing that economists in 2020 have really got our teeth into. We've had to come up with new ways of analyzing what's happening in the global economy. We've had to come up with new data to track to get a sense of things in real time. But the bad news here in Europe is clearly things have gone into reverse, as I'm sure we can all feel in our various degrees of lockdown. But it's important to stress that not everywhere is feeling that same pinch. Actually, in some parts of the world, the COVID crisis is a little bit more under control. Things are still improving ever so slowly, but nonetheless, this is a very divergent global economy right now, and that's one of the key messages I'd like to get across. On the next slide, we can start by looking at what's happening in Europe. And it's really, really bad news, I'm afraid, if you're a European economy right now. We're all back in lockdown. Now, that lockdown isn't quite as bad as it was in the spring. You can see on the left-hand chart here that really things were in the spring about 30 to 40% lockdown in most European economies. Now it's about 5 to 10 to 20%, substantially lower numbers. That doesn't mean the economic impact isn't any less, and we're likely to see a much greater impact of this second wave of lockdowns in the coming years. Because the big risk here is that this additional lockdown really punishes a lot of businesses, and we start to see business bankruptcies rise, we start to see unemployment levels rise, and these spillovers are quite likely to linger in the impact on the global economy and in Europe in particular. And this second wave of lockdowns means that we could well see much weaker economic growth through the course of 2021 and maybe even into 2022 if there's a substantial disruption to businesses. Now, the next slide really focuses a little bit on the UK, and here things are, unfortunately, and for myself as someone sat in London, even worse. I think if you are a UK corporate right now, you are not only facing the challenges of COVID and lockdown 2 and all of these risks that I've just talked about in Europe, but we of course have this lingering threat of Brexit. And for the UK, we have an unemployment rate that's rising. We have an economy that was already slowing going into the second lockdown. And now we've got an additional headwind for next year as well. It's going to be much, much harder for British businesses to invest and to grow back in this environment. And for us, we think the UK is quite likely to be the worst performing major economy in the world. Now, it's worth changing tack a little bit and moving on to the next slide where we look at the US election. Now, in Europe, things may look pretty bad, but in the US, we've got a new dawn in essence if Joe Biden takes office on the 20th of January. The problem is for economists is while that's all very exciting and there's lots we can talk about in terms of what this means for the world, actually, we don't really know what the true impact of a Joe Biden presidency will be until the 5th of January. And that's because we've got these Georgian Senate runoffs. There's 2 of them, and if the Republicans win one or both of them, they will control the Senate. And that means Joe Biden can only really put policy through by executive order. It's likely to focus on trade, on climate, and on the response to COVID-19. Now, there's a chance if the Democrats win both of those seats, they will control the Senate. That will give Joe Biden a lot more power to push through some of his broader policies on the fiscal front, so higher tax rates and a bigger infrastructure spend across the US. So the possibility is there for a much greater impact of a Joe Biden presidency. But as we can see on the next slide, actually, the US economy until this point has been doing relatively well. You know, people have had money in their pockets. You can see that on the left-hand chart. Income growth in the US has been pretty strong this year, mainly because of the nature of the stimulus provided by the administration there. But consumers clearly cut back their spending when lockdowns are introduced and people cut back on spending, particularly on services, as you can see on the right-hand side. But that's now really started to recover. Now, there's a big rotation into goods consumption, as I'm sure all of us can sort of agree with, that we've probably spent much more on goods than services this year. And a lot of those goods consumption have been brought forward. So it's all the things we've needed for working from home, for our home gyms, all the things we've decided we can buy online, which we didn't do before. All of those shifts in our consumption patterns have meant goods consumption has been really strong, even if we can't necessarily spend as much on recreational activities, on holidays, and going out with our family and friends. So clearly some impact there on the economy. I just want to turn to another story across the world, which is in China, where things are considerably better. And you can see on the next set of charts that the recovery in China has really broadened out in the past couple of months. Back in the summer, it was pretty clear that China's recovery had started, but it was so heavily concentrated on the industrial side of the economy, on manufacturing, on investment, and these sorts of things are pretty easy to get back online. The problem is that it never really engaged with the consumer, who was very, very cautious for quite some time. But now that has changed. And there's a bit of a turnaround in those Chinese numbers in the past few months where consumers have started going back out and spending. And encouragingly, it's not just on the good side of things. The data we got actually on Monday for October showed that restaurant sales in China are now up about 6% year on year. So actually there's a good sense that the Chinese consumer is starting to feel a little bit more confident. And that good news spills over to the rest of the world because China importing more products helps to lift everyone else's exports. And so far in this pandemic, those Chinese import numbers have been negative. And again, in the past few months, they've turned positive. Some good news coming from China that should help, fingers crossed, to lift the rest of the world. Now, there's some good news, and I'm going to put it right back to some bad news, unfortunately. On the next slide, we can see how the number of people who have lost their job in the US has been quite dramatic, even compared to the financial crisis. And even after 6-7 months of recovery, we're just about back to the worst point of the global financial crisis. Now, the trajectory there is quite encouraging, and we should continue to see more job gains in the US. But actually, what happens if they roll over? What happens if we continue to see a drop in employment that makes it much, much harder for the recovery to continue? And this is US data, but the same story could be playing out across the world. Many countries' data are heavily distorted by furlough schemes or similar sort of programs. And of course, there is a risk that those jobs don't come back or more businesses go bankrupt. And these are all of the challenges that the global economy faces going into 2021. The hope is at least that we can bridge that gap and we can keep the economy going long enough until we get to a vaccine world, in which case then things can recover much more strongly. But there is a risk at least that those jobs numbers mean that there isn't necessarily the demand going forwards. Now, it's worth changing tack a little bit, and the next couple of slides are going to focus on something a bit different. So we're going to think about some of the long-term trends that are happening as a result of the pandemic. And it's not all doom and gloom. I am an eternal optimist, and I always try and find the positives in the world, and this year has been more challenging than normal to try and find them. But I think there's a real sense of change that's happening in a number of ways, which are relatively good news. The first of which is about the big digitalization of the economy. We've seen in the course of the past few years, many countries across the world really turning their back on cash. You can see that on the left-hand chart here with UK cash withdrawals down a long way, even in February and March, but throughout the pandemic, they've dropped even more. We don't think that cash is going to come back. And what we're seeing across the world, particularly in the emerging markets, is a greater shift away from cash payments than we've ever had before. And that's good news. It's a big efficiency gain for businesses. It helps to get people banked. It helps to lift growth across the world. So there's a good news story if you're desperately trying to find one for the global economy in 2020. But it's also worth thinking about the big digitalization of the global economy more broadly. This pandemic has accelerated a whole load of trends, and this is clearly one of them. We think now that by 2030, about 50% of retail sales could be online. That's partly driven by demographic change. Young people who shop online more are going to be a bigger and bigger share of the consumer population. But also the pandemic's made us all realize about the goods and services that we want to consume online, that we like consuming online, and we're therefore likely to see a continued movement in that direction in the coming years. That number may seem mad. People say 50% of retail sales online seems too high, but just think about all the things we used to do 10 years ago or so that we do virtually today. You may have bought CDs, you didn't have Spotify, you didn't have Netflix, you may have even gone into a shop to buy your holiday. And those things now seem crazy. And I think in 10 years' time, there's a good chance we look back and question some of the things we did physically today. Now, all of these things have enormous implications for the economy. And the next slide just runs through some of those issues we need to think about. In the interest of time, I'm not going to run through them all in excruciating detail, but they're just things we start to have to think about in terms of the economic implications of all of these shifts towards a digital economy. Clear impact on jobs. We're likely to see automation increase. We are more likely to see remote working become a much more persistent trend, and fingers crossed, I hope that leads to more flexible working. I think all of these trends are hugely productive, and they could mean lower inflation rates. And we could see governments across the world start to invest much more in the technology space. But also for us as economists, it's much more challenging, because if you shift a product being consumed physically to digitally, it actually disappears from a lot of the economic data. And that's a big problem for us. So actually, we get measurement challenges going forward. So while there's a lot of good news that comes out of the digital economy, there's also some serious challenges. Now, let's just have a look at policy. My next couple of slides look at monetary policy and then fiscal policy. So on the global policy rate in terms of monetary policy, we're expected to see rates stay very, very low for quite some time. We now have the lowest global interest rate we've ever had. We don't think that's going any higher in the course of the next 2 years. No global central bank has put out any sort of suggestion they will be tightening policy anytime soon. The only two G10 central banks where we think we could get a monetary policy rate change by the end of 2022 are in New Zealand and they're in Norway, and two central banks that I presume are not big ones in anyone's focus listening to this. So what about fiscal policy? That's far more important. And you see on the next slide how much debt has been built up during this pandemic and how much is likely to have to be built up in the course of the coming years. You can see You can see those numbers are much, much higher in 2022 than they were in 2019. All of that is partly driven by some of the pickup in spending so far. So spending on healthcare, spending on job schemes, spending on supporting businesses. But there's also the chance that many governments across the world are going to have to spend much, much more money in the course of the coming years to help us grow back stronger. That spending is likely to have to be focused on infrastructure. It's going to have to be focused on the digital economy, as I said, and importantly, it's going to be focused on the green economy. We've seen announcements in the UK this week. We've seen announcements in China and Germany and many other parts of the world on this front. And actually, that could be one of the big policy levers that is pulled in the coming years. And I think that's good news and is spending that should be done. But it does mean there is a risk that government debt levels do rise in the short term. And that's just another reason why central banks across the world are going to want to keep their policy rates loose, just so this high level of debt can be much more sustainable. Now, on the next slide, I just want to give you some positivity. Unfortunately, most of my presentation is largely negative, but there is hope. There is hope, and there's no point denying that at the moment. There's the fantastic news in terms of vaccines in the last week or so really do give some confidence that there should be a strong rebound next year. Now, there's a challenge, of course, as I said, that we get some businesses don't make it through to then, or some jobs don't make it through to then, some huge challenges that are out there. But what happens when we get there? And when we get there, the evidence so far is that people love doing things. If you look at New Zealand, it's not the perfect comparison for most other countries in terms of the COVID response, but people across the world are remarkably similar. And the first weekend after social distancing was relaxed in New Zealand, you can see on the left-hand chart, people went back to the rugby. And that is the best example, I think, of the willingness of people to get back out and spend and get amongst other people. And people were willing to do this. The crowds in Auckland at the Blues match, the first one after social distancing was relaxed, packed stadiums, fantastic to see. And then we've seen in New Zealand more broadly, away from rugby, a willingness to go back and spend on services. Services spending in New Zealand in October higher than a year ago. That's suggesting that people are willing to get back out and spend. And even domestic flights in New Zealand, you saw the flights going in and out of Queenstown pick up quite sharply in July. Straight away, people want to get back out and do things. And we're seeing examples of this across the world, of people packing into bars and restaurants and flights the second they feel safe. And I think there's a lot of pent-up demand next year that could be unleashed. The real challenge is seeing what state the global economy is in when we get there. So my last slide is just looking at our forecast, just to give you a sense of how we see things. It's bad news, unfortunately. Those growth forecasts on the left-hand side are particularly negative. It does look like a V-shaped recovery in terms of the growth rates in 2021, but it's really important to think about those levels. By the end of next year, we're likely to see a global economy that is just bigger than it was at the end of 2019. That's clearly an environment that's less supportive for investment, but also it's a long, long way below where we expected it to be at the beginning of the year. So a recovery, but still one that's relatively disappointing. The recovery is most likely to be disappointing in the UK. You can see on those forecasts, we had to cut our forecast for this year and for next year. So while most countries across the world, we've got a bit of a drop and a bit of a rebound, the UK, we have the sharpest rebound and one of the slowest recoveries. And that's the risk that Brexit creates for the UK recovery. So there's my run through of the presentation. I think we've got a couple minutes to take any questions, if there are any, on the global economic outlook, on things I've talked about, or anything I haven't, because I always say to people, there is a risk by being a global economist. Theoretically, I can take questions on anything. So let's see what comes up. Thank you very much.
Well, thank you, James. You just set yourself up there. Thank you for a great presentation, compelling, well-paced and rich with information, and I'm sure a great foundation for the panel discussion coming up on cash and risk management. Now, your bad luck, the bad news for you is I'm an economist, so yes. Let me throw a few curveballs at you. I saw in your slides a lot of reference to the impact on business of COVID, the second lockdown. And you touched on the uncertainty of the American political environment. And then you touched on rising debt. If I add up those three factors, are we heading into a potential sovereign debt crisis in the next couple of years if governments cannot get those debt levels down or find that they don't have the political cohesion to service those debt levels?
Yeah, it's a very good question. And in all honesty, we're less worried about the risk of these high levels of debt becoming problematic than we were in the past. And that's mainly because of where interest rates are. Now, you've got a load of governments across the world who are spending a lot of money at the moment, and as I said, will continue to do so. And in the absence of business investment and uncertainty, they're going to have to keep spending. So those debt levels are going to keep rising. But the big difference now compared to in the past is the ability to pay for it. You know, most of the countries in Europe, at least, and even in the US, where rates are still very low, but most countries in Europe, those governments are now borrowing at a negative interest rate. So actually, the ability to pay that back is much, much easier than it was in the past. And actually, we think as long as central banks keep their foot on the gas in terms of monetary policy, then those higher levels of debt can be sustainable, at least in the medium term. At some point, things need to turn around, but those debt levels will probably start to drop off in the coming years, mainly because of the interest rate being so low. That stock of debt doesn't really change that much. And therefore, if you can grow the economy just at all, you can actually start to erode at those ratios going forward. So the risks are clearly out there. And if things really roll over, that we could start to see these same issues resurface. But at least in the meantime, the low interest rate, I think, is a really important component of that. And that's why we're not going to be seeing any rate rises anytime soon.
Okay, well, I'd love to hog the rest of the questions, but it would be totally unfair. So we have some coming in from our audience. Let me throw one at you. A little bit easy for New Zealand to do a good job, given that it's a remote island.
Yeah.
Fair point?
Oh, completely. There's clearly an element of chance in countries' response to COVID, how many infections you had to deal with at the start, how easy it is to lock down, how easy it is to close borders. New Zealand, unbelievably favorable. And therefore, they can have this quick control of COVID and they can bounce back very, very quickly. But New Zealand suffers from two things. One is that they don't have tourism. It's about 10% of New Zealand's GDP is tourism. That has gone, so they don't have the same economic recovery as many other economies that are bigger and therefore have domestic markets. So I don't like using New Zealand's policy response. What I do like using is what Kiwis have done the second they're allowed to, because I think that is a useful barometer of what other people elsewhere in the world might do. And that is supported by how quickly people across Europe went straight back on holiday the second they were allowed to this summer. I think there's a clear sign that quite a lot of people want to get back out and do things.
Oh, you said it. You got that one right. And then a final question from our audience, and we encourage everybody to send in their questions. We'll read out as many of them as we can. The final question would be, no sign of currency volatility in this crisis yet. If we go into 2021 with more lockdowns, and governments start to get into trouble in terms of their ability to fund further extensions of business support measures, could that be in store for us next year?
It could be, but where we have seen the currency volatility this year has been in the emerging markets who don't have that same policy toolkit. Now, if you're Brazil or you're Turkey or you're India, these large emerging markets where putting in lockdowns is far more economically damaging, and therefore, and you don't have the same amount of government sort of ability to support the economy through furlough schemes, through business support, through all these channels. These currencies have been beaten up quite badly this year. Whereas in the developed markets, I guess because everyone's in the same boat, everyone's got the same issues. Everyone's got super low interest rates and not doing anything with them. Everyone's got lockdowns. Everyone's got a rising level of government debt. And so because currencies are sort of pairs, it's not like anyone sort of massively underperformed each other. You look on those forecasts that we've got, and we've got massive recessions in every developed market. We've got a slow recovery in every developed market. And actually, it becomes very hard to get currency volatility in that world. What we obviously could see is that sort of divide opening up. And that would be if certain parts of the world really got on top of COVID and had a fast recovery, and other ones didn't. And actually, that would create some currency volatility. But for now, things look to be relatively steady, which is at least something positive out of this pandemic.
Very good. James Pomeroy, global economist with HSBC. Thank you so much for a presentation that was compelling and full of impact. And as I said earlier, it's laid a great foundation for what we're going to talk about in the remainder of the day. And thanks also to HSBC as a very kind sponsor. Now, You may think it's a little bit early for speed dating, but we don't. So we are now going to cut to a 10-minute icebreaker session, and we're going to encourage you to go to the left-hand side of your screen, depending on how your computer is configured. It should be the left-hand side, and to visit as many of the other participants and exhibitor booths as you possibly can in the 10 minutes that we have during this speed dating session. And to give you an incentive to do it, IACT have kindly agreed to donate to a children's charity in proportion to the number of hits that exhibitors get. So the more exhibitor booths you hit, you will be presented each time with a multiple choice question, and you will have to guess the answer to the identity of a superhero character from the world of fame. And every time you get it right, you will get a code. You then go to the delegates, you go to the leaderboard and you enter the code, and you will get 25 points. And for every 25 points you notch up, the IACT will donate money to one of 3 children's charities. They are Bernardo's, the Jack and Jill Foundation, and the Barrettstown. And we'll tell you a little bit more about how those will be selected later on. You'll also be in the running for a €150 voucher. So we will encourage you now to get active, to meet each other, engage with the exhibitors, and we will see you back in 10 minutes. Welcome back, everybody. Hopefully you got a chance to interact with the exhibitors and with each other, and hopefully you got to raise a bit of money for our 3 very worthy charities, and you had a bit of fun as well. Now, coming up soon, we have our first expert panel on the hot topics of the day, risk management, cash management, and liquidity planning. But first, we've done a bit of speed dating. We're now going to do a bit of speed polling, because we want you to have your say on the key issues facing corporate treasury at the moment. So the questions we have, 5 in all, will come and go quickly. So we need you to have your mouse at the ready, and we need you to have your wits about you. I'm going to read out the questions, and I'm going to read out multiple choice answers, and we need you to be quick on the draw, because you'll have about 20 seconds to give us your answer, and we will read them out at the end of each question in sequence. So here we go. Question 1 is, can you identify your #1 external concern for 2021? Is it A, cybersecurity, B, geopolitics, C, financial market volatility, D, tax and transfer pricing? Is it E, Brexit or trade wars, F, financial regulation, G, the COVID crisis, or H, transition to risk-free rates? On your buzzers, get set, go. And the results will be coming up now in a second, I hope. I must say I'm intrigued to know whether everybody's going to go for COVID. Maybe for some of us the COVID crisis is not as big as some of the other concerns, but let's see. I'm hoping now we will get something in a few seconds. Have we got a result? Have we got a result? We don't have a result yet. I feel a little bit like Pat Kenny doing the general election. Let me see now. Am I looking at the right window? Okay, so let me see now. Okay, so 32% for COVID. That's the leading factor of concern in 2021. And the next factor is, if I can read it, geopolitical factors, I think coming in at 18%. We then, at a joint tie, have, I think, cybersecurity and Brexit at around about 13% each. And we have then financial regulation, eternal bugbear at about 5%. And we have tax and transfer pricing in at, I think, around about 1%. So those are the results for the first questions. Let's quickly go to the second question. Suggest your preferred Treasury breakfast topic for 2021. Is it environmental, social, corporate governance? Is it rating agencies? Is it tax and accounting? Is it ongoing impacts on Treasury? Is it FX risk management? Is it cybersecurity? Is it digitization of Treasury? Is it working capital optimization, or transition to risk-free rates? On your marks, get set, go. So hopefully those results will be coming up in a moment. Let me see if I can read them. So the first one again is, the first one is digitization of Treasury as 37%. The next one is environmental, social and corporate governance. I know that's sweeping across the corporate world at the moment. The third one then is tax and accounting at 12.3. And I think the also-rans would go fourth is working capital 10.5%, and the remaining categories, I think, coming in under 10%. We won't read them all out because we don't have time. We'll maybe focus on the top 3 or 4 to move things along. Now, the next question. Currently, and for 2021, identify your biggest treasury challenge. Is it A, cash management and forecasting, B, financing and capital allocation, C, treasury technology and automation, D, financial risk management, E, regulation, compliance and know your customer, or F, transition to risk-free rates? On your marks and buzzers, get set, go. So we hopefully get the results in the next 10 to 15 seconds. And we will call them out. All right, so we have in the lead C, Treasury, Technology, Automation at 50%, I think. And then in second place, we have Cash Management and Forecasting. That's option A at 20%. And then third, transition to risk-free rates. Not sure what the percentage is there. We might get that in a minute. That's at 18%. And then fourth, we have regulation and compliance, quelle surprise, at 11%. Very good. Now, question number 4. What is your greatest time-consuming treasury task? Is it A, payment management, B, cash forecasting, C, compliance or regulatory issues, D, reconciliations and accounting, E, regulation, compliance and KYC, or F, debt and investment activity and relationship management? On your marks, go. And we should have the results coming in now in a few seconds. And we have in joint first place, sorry, the results are changing as I speak. Payment management is what most of you opted for at 22.7%, actually jointly with regulation and compliance and KYC. In second place is cash forecasting at 17%, and then third is compliance and regulatory issues at 12.5%. Final question. Are there any other initiatives you would like to see the IACT introduce in 2021? A, DCM, B, rating agencies, C, shareholder value, D, accounting, E, tax, or F, ESG? And so far, I have to say, there is a clear winner, and I'm not surprised. ESG is running away with it at 100%. And that does, oh, hold on. The race is changing. ESG is at 50% now, and we have DCM at 37.5. Gone down to 25, but still in second place. I feel like I'm commenting on a race on punches down here. Shareholder value coming up at 15.4%, jointly with rating agencies, and then tax in fourth place. Nobody opting for D. So those are very interesting results from that opinion poll. Now, I think we're in an excellent position to turn to the burning issues of what has been a truly outstanding year for corporate treasury, one in which I think the profession has truly distinguished itself in facing challenges unseen even during the last crisis, and I think playing a pivotal role in keeping the economy open. So now, to discuss cash management, risk management, liquidity planning, and the new world of remote working, I'm delighted to introduce Fiona Hughes, APJ Treasury Manager with Hewlett Packard, Remco de Vries, Group Treasurer with Experian, John Donegan, Treasury Director, Hewlett Packard Enterprise and Financial Services, Teresa Kelleher, Head of Group Treasury with the Musgrave Group, and last but definitely not least, David Chinkins, Global Head of Cash Management Sales with Barclays, who are our kind sponsors today. Fiona, the floor is yours.
Thanks, Mark, and good morning, everyone. So as we have three corporate treasurers and one banker, the focus of the panel discussion today will be around risk management, cash management and liquidity planning. So to kick the discussions off, we'd like to hear from the panel what have been the biggest challenges facing their organisation during the COVID-19 crisis in terms of liquidity and cash management. So maybe Teresa, we'd like to start with you because I expect being in the retail business, there was immediate demand on working capital.
Yeah, thank you, Fiona. Absolutely. So I suppose we're both a retail and a wholesale business. We're retail through brands like SuperValu and Centra. And then on the wholesale, we have cash and carries, but we also have food service, and we're operating across the Republic of Ireland, Northern Ireland and Spain. I suppose overnight, we saw the food service segment of our business ground to a halt as restaurants, hotels, bars closed overnight. And on the retail side, we saw higher demand, but equally we saw additional costs of doing business, such as safety costs like hand sanitization and other products needed to make us all safe in store. There was also a change in how we as consumers brought our groceries and paid for them. For example, more people started using contactless instead of cash. And we also saw a move to online, in particular for, I suppose, people that were cocooning. From a cash flow perspective, on the food service side, we had customers that needed support. And on the supplier side, we had smaller suppliers who would have been finding it difficult to, I suppose, put in place their own facilities to be able to meet increased demands. And I suppose we also needed to source products that we'd never sourced before, things like masks. The challenges that we saw from a Treasury perspective were that we went from monitoring our cash balances daily and setting working capital parameters to needing to drill down to understand segments of our customers and suppliers and how they were potentially going to impact our cash flow, either in a positive or in a negative way. We also needed to track individual high value spend versus just simply, I suppose, funding individual trading divisions in a more general way, while we assessed, where we were and what the COVID impact was going to be. We have a very experienced team across finance, in particular our credit control team, and this was of huge value in understanding the underlying, I suppose, segmented cash flows. But it did highlight to us that, I suppose, our working capital reporting and our treasury management system could work better to provide us with more detail around the cash flows. And we since set about putting that in place. We also needed to consider our headroom. We've always had a minimum headroom level set within our treasury policy for many years. But we had to question, was that at the right level to give us comfort in an uncertain environment and where, I suppose, cash flows were behaving in a different way. Ultimately, we felt to give us comfort, we would benefit from increasing our minimum level of headroom. And I suppose we set out about looking for a credit approval on an accordion that we had attached to our bank facility a couple of years ago. Our bank partners were very supportive and we're very grateful for that. And that overall process went smoothly. From a headroom perspective, we also looked at restricted cash, bringing it back into our trading divisions. And we also reviewed all of our ancillaries, in particular our guarantees, maybe with revenue, for example, to make sure that the products moved as freely as possible. And that we weren't putting a lot of cash up front. I suppose to sum it up, the two main challenges for us was more visibility around the segment drivers of our cash flows, and ensuring that our headroom was set at the right level.
Okay, thanks, Teresa. So Remco, maybe from a corporate treasury perspective.
Thank you, Fiona, and thank you to the IACT for having me on this panel. Yeah, what a month it has been, March. For Experian, March is always a bit of a special month already, because 31st of March is our year end. And typically in the sort of cash cycle, March is the best cash month of the year, which means that in order to get our balance sheet to, if you like, the fittest position and the best looking position at the end of the month, we typically make sure that we stack up a number of commercial paper maturities up in a month to make sure that levels are, are the best as at the end of the month. Few quick numbers just to give a little bit of context. The funding that we started off with back in March, rounded to the nearest $500 million, was $2.5 billion of bonds, long-term debt, about $1 billion of drawn bank debt a few years out, and then $500 million of commercial paper, all short-term. What we started to notice in March, and I'm sure many in the audience will have, is in that short-term liquidity space, things started to wobble in March. Our dealers, our commercial paper dealers, started to come back later when paper went away. They became a point they needed to warehouse it on the balance sheet overnight. And points came that they actually started to struggle to get it away. And when at some point even get it at very elevated levels. So as March unfolded, and also halfway through moving the whole team to work from home, we decided to do a few things. First, of course, all of the plans and the forecasting of funding and the year ahead, and because of our year end and the budgets, etc., that had just been prepared for the financial year, were essentially torn up and thrown out the window. So number of, call it, emergency scenarios. What is this pandemic all going to look like? What is the cash flow in the business going to look like? All of that was certainly quite uncertain. That meant we decided that we would take forward some funding, bond funding, so issue a bond, take that forward into March when we could. We were planning to do it in June. We have a closed period in April and May. So see whether we could actually get this bond away before the closed period. The other was the Bank of England at the time was the first one out of the blocks with a liquidity support scheme, the COVID Corporate Finance Facility, CCFF. Because we have a decent sized business in the UK, we would qualify for it. But in order to qualify for it, and in order to apply for it, you need a European commercial paper program, and ours is a US program. So immediately put the lawyers to work. Please get us an ECP program because we need it. Those were the, if you like, the immediate things that we proposed to the board, and making the board comfortable that our funding was in order, also to try and make sure that we would not need to use our main RCF that was backstopping us. Two other things we did in terms of, call it, liquidity preservation. One was we had about, at that time, agreed a relatively large acquisition, a few $100 million worth. And normally we would always settle our acquisitions in cash. This time we agreed with the seller, we actually will settle this in Experian shares. So to preserve that liquidity again and keep the cash in house. The other thing which is us as a treasury team needed to change our mindset 180 degrees. Usually, because Experian is quite a cash-rich company, our conversations with the region is, what's that cash doing on your bank account there? Send it to us. Insofar as it is not on cash pools, in-house banks and liquidity structures, we want you to send us our cash. Those conversations started to turn around. Are you sure you have enough cash? Because sometimes, and particularly the far-flung places, the regions further away, perhaps where it would be a bit more work to get cash into there, was something we were concerned about. Fast forward a few months, So, sorry, just to say, we issued a bond on the 31st of March. All lawyers working from home, us working from home, bankers working from home. It was all a bit of a strange experience, but I have to say it all went quite well, and the bond was actually quite a success as well. Fast forward to June. June was when bankers started to phone up and say, Remco, we've got these facilities with you. You know, this is the medium-term debt, but banks' balance sheets had exploded. Their cost models had changed. Some of our facilities were, quite affordable. So they said, Remco, we can't extend it at the same price. We need to talk about this. When this comes up for renewal, we need to have a conversation. So that was one that we took forward. We had to renegotiate a few, but then over the summer, the bond markets and the CP markets got on fire again. And we decided to be opportunistic about this. First, use the CP market and refinance where we could, out of bank debt, and also issue a bond in September again at a historically low coupon. So if you round it up where we are today, we've presented our numbers, our half-year numbers yesterday to the stock exchange. It's actually been quite a decent half year. We've even grown the business 3% and the second quarter 5%. And if you look at funding where it at this moment sits, it's all long-term funding. We have de-risked quite a lot out of that funding profile. So that's a snapshot of what what COVID has brought to Experian. Other than a cat and some facial hair. But Fiona, I'll hand it back to you.
Great, thanks, Remco. So, John, maybe from a risk perspective, how is this managed by Hewlett-Packard Enterprise?
Yep, no, thanks, Fiona. I think certainly a lot of similarities and parallels to what Teresa and Remco have already gone through, but I'll take you through the HPE perspective. So same for everybody. March, April, May was a real critical time for HPE. And then we started to see that thaw out in early June, and then things started to normalize a little bit. But in terms of risk management, our approach was always pretty simple in terms of, well, how do you de-risk the funding plan? And our thought was, well, we do that early, and we also do that by having access to both secured and unsecured funding markets. And that was really the cornerstone of our plan. So it sounds pretty simplistic, but I'll break it down into a couple of different areas. And we think when we added that all back up, it did present us and give us a very robust funding plan for HPE and for HPFS. So some things were a little bit fortuitous, some were good timing, and some was certainly good planning in the context of COVID-19. And maybe it's been well said, but one of the maybe nice comparisons or succinct comparisons that I've heard over the course of the last 6 months with respect to how do you compare COVID-19 in 2020 to the financial crisis in 2008 was that back in 2008, that was really a credit to liquidity problem. Started off as a credit issue and turned into a liquidity issue over the course of time. And 2020 was an issue that started as a liquidity issue and then developed over time into potentially a credit problem. So we can talk about that in the context of some of our business units as I kind of go through some of these pieces. So maybe to start with short-term funding. So same experience in terms of ECD and ECP markets where we would normally play. They dried up very quickly around about mid-March. So as a tier 2 corporate at that point in time, investor money was simply off the table. We did not have access to those markets for a period of time. And we did certainly do our research as well with respect to what type of central bank support programs were available. And on our shortlist as well was the Bank of England CCFF program. Ultimately, we didn't end up drawing down on that program, but we did go through the logistics required and the documentation needed. We did have an ECP program, and we applied and were accepted into that program. So the Bank of England would come on board as an investor to our ECP if we did require funding. Now that actually gave us about 600 million sterling in terms of an availability, so which we really treated as kind of committed funding per the terms of that facility, which was very useful to have in our back pocket. I think that's really where we got a lot of value add from our bank partnerships, because in terms of finding out about that program, how you connected into it, how you set it up, no, that was all valuable knowledge that came to us through our banking relationship. So certainly thankful of getting that intelligence quickly. And I think we turned around the application in about a week, which was quite useful to do, because at that point in time, it was very difficult to understand if that liquidity issue was going to deepen. So it's okay now in hindsight to say we didn't need it, but to have access to it quickly, that was a critical thing. So then in terms of that short-term liquidity, we did see it to start to return in early May. But at that point, spreads were quite elevated, as most people will reflect on it. I think for ECD, we were probably about 250% above our normal spreads, which is quite expensive. And also the duration was quite shortened. So we would have access to ECP, ECD out to 12 months. And that duration then at that point in time was down to 3 months. So that makes the whole cash planning funding equation a little bit more complex when you can't or don't have access to your standard or normal durations. But then as we got into later months, we started to normalize, and I would say it's relatively normal for us now at this point in time in terms of our ability to issue there. Long-term liquidity then was a little bit of a different experience for us. We did have certainly a lot of pressure at the front end of the market. So out to 5 years, that market was a little bit sluggish. We did in early April take that decision to de-risk our funding plan. We had planned to issue a bond later in the year, but post the board meeting, we took a decision, no, that's not what we want to do. The situation could get worse than where it is right now. So if we have a bond issuance to do, we want to do it as soon as possible. And lots of corporates follow that template. I think if you do look at the statistics around US bond market issuance for corporates around that around April, May, June timeframe, you'll see a significant amount of volume over and above anything that would be considered normal. So we did issue in April 3 and 4 year bonds to the tune of about 2 billion plus. It was actually well taken up, but spreads were pretty high. I would say maybe around 300% greater than normal. So quite a cost, quite an expensive time to issue, even though bonds were getting away and there was demand and oversubscription there, which was good to see. By comparison, then what we did is issue a further bond in July, so completely de-risked quite early, and that was much better in terms of pricing. So at that stage, spreads had pretty much normalized, and there was approximately a 250 basis point improvement in terms of the issuance cost. So pretty significant. Duration was pretty similar, 5 year timeline around about there, and approximately 1.5 billion. So pretty active in terms of the liquidity we wanted to roll over, the liquidity that we did want to access as well. We did have an acquisition that we had planned to pay for later in the year, so we certainly wanted to have cash on hand to accommodate that. And we did want to ensure that we had our normal operating cash levels protected, if you like. Couple of other maybe quick things to mention in terms of the ABS market. So that's where the secured funding piece came into, and maybe my earlier comment about some of the timing was maybe a little bit fortuitous for HPE and HPFS. And I say that because in 2019 in September, HPFS entered the ABS market for the first time. So it gave us access to ABS, which we ordinarily wouldn't have had access to. So as we went into COVID, we had more than our normal options available to us, which was good. So in terms of what we did, again, timing was a little bit on our side in terms of the first issuance that we did in 2020. We actually completed that in February 2020. So about 3 or 4 weeks really before the markets became very, very nervous with respect to what was happening with COVID-19. Subscription there was pretty good, competitive spreads that we did see, but certainly higher base rates. Our second issuance then we started in April. At that point in time, the timing wasn't great. It was still very uncertain. Market was waiting for a lot of details about support mechanisms, new TARP, etc. And a lot of investors were still very much on the sideline. But by the time we got around to completing that issuance, which was late June, investors were coming off the sidelines, and really we saw a huge huge difference between early June and late June, and that was really the turning point, we think, in terms of ABS investors getting a little bit more confidence back into them about the market. That second issuance was for about 1 billion, a little bit over 1 billion, as was the first issuance. So again, a lot of activity. So spreads in that second issuance were a little bit higher than the first issuance, but the base rates were quite lower. But again, we were very pleased to complete that transaction on time, and certainly it helped to complement the funding plan. The HPFS leasing business, then, just to maybe mention a couple of quick things about that did come into our factoring. The cash flows there did become a little bit riskier, because forbearance was now part of the norm with respect to what customers were asking for. And maybe the brief statistic is about 10% of that global portfolio of lease business, which is approximately 12.5 billion, requested forbearance for 3 months. So our task in Treasury was really to understand what the business wanted to do with originations in the face of lower cash inflows coming off against clients who now weren't going to make payments for 3 months running. So we had to do certainly some discussions with the business in terms of balancing that equation, so there wasn't a huge impact for free cash flow. Other quick aspects to mention, aligned with what Teresa said in terms of more operational discipline around our cash balances, making sure that we were quite disciplined in pushing cash to our in-house bank. So we were pooling all of our surplus cash as we would normally do. We've always had pretty good discipline with respect to our cash balances on a daily basis in terms of observance and pooling surplus cash. So certainly kept that up. A little bit more discussion with our tax colleagues with respect to opportunity costs, and that cost benefit equation of tapping some of the standard or typical restricted cash pools in countries like Brazil, India, etc. So certainly some trade-off there that we did take advantage of. And last, we did have that contingency plan. Remco mentioned that as well in terms of the corporate revolver. So HPE also does have its corporate revolver of 4.5 billion. So that was, if you like, our second line, our fallback position. But thankfully, we did not have to tap that. So maybe that gives you some insight into funding plan and how we just de-risked it over the course of the last couple of months.
Okay, thanks, John, for that. So David, from a banking perspective, how did Barclays cope with COVID-19 and the changes?
Sure, Fiona, thank you. And firstly, thank you very much again for the invitation for today. But I think as a couple of points, as everyone knows, Barclays clearly is a universal global bank. Clearly, the way that COVID impacted the different areas of our bank was quite different in some areas. So as you can imagine, the first part, given the size and scale that we are in the UK for our consumer businesses, through our ring fence bank, clearly one of the major concerns, clearly as we started to look as the COVID crisis hit, was firstly around obviously the government furlough schemes that were coming into play, to particularly in those sectors such as consumer, healthcare, retail, wholesale. So businesses that were really being impacted by the lockdowns that were starting to come. If you sort of take that more across clearly to our corporate investment bank, so obviously where I sit, of course our clear concern clearly was making sure that we were able to support our clients. Obviously that's the primary focus, supporting our clients through what was and could have been quite a significant period of time of uncertainty and change. The most important thing is, as everybody's mentioned earlier on, so whether it was the business banking, the corporate banking scheme, so the BIBLs and SIBLs and syllables schemes that were being introduced by the UK government, and of course the CCTFF, obviously has been mentioned earlier by both Remco and John. The most important thing for us was to be able to execute those plans at pace and be able to give the right level of information to our corporate clients. That was one challenge, as you can imagine. Obviously, we executed that clearly with working with the central bank, obviously trying to get that out into play. The second point I would also touch on is also managing through times of uncertainty. As we heard earlier on, the foreign exchange markets, we have a lot of other things happening this year. Clearly not just COVID. We've got we have the Trump election looming. We've got clearly Brexit coming up towards the end of the year. All of which is adding to, I guess in this case, corporate treasurers' uncertainty as to how the markets will respond and react. So it was ultimately making sure that two things. One, we had the right level of information and insight that we could deliver to our clients about the impact of what actually this could deliver to those clients. Secondly, transforming our entire workforce. We have a workforce of 88,000 employees around the world, moving them all to a work from home environment, which, as we can all see today, has worked actually unbelievably seamlessly well. We've all transitioned with no major impact to any of our core businesses, any of our core systems. But the most important point I would also state is, for Barclays, I think what has actually happened, it's allowed us to actually directly increase the level of investment we've built out into our digital capabilities. So what we've actually seen is that all of our businesses, whether it's our people enablement, so the technology and capabilities we have as a bank for our frontline bankers, secondly, for our corporate clients, so around the digital services and tools that are available to them to have full access and view of their corporate cash and treasury and liquidity solutions. But the final point I would say is just the ability to make sure we weather that storm in the best possible way. The final thing I would say also is, let's think about it, right? Ultimately, this is about culture. The way we're operating, we're working now today, like this conference, we've had to all move to this digital environment. It's the way of how we continue to make sure we engage with the clients. We make sure we still understand their needs. We still make sure we've got that relationship, because this is about relationship banking. It's that long invested relationship we have with our clients to help them through these difficult times. And I was really pleased about how our teams came about that, and I was pleased to hear, obviously from the other clients that we have on the panel today, of how they've been supported by the banks. But Fiona, let me hand back to you.
Thanks for that, David. And I mean, as you mentioned, in terms of working remotely, so John, I know you have a global treasury team. How has working remotely, worked out for the team over the last couple of months?
Yeah, well, we've always worked remotely with our groups across the globe. So moving from the office environment to the home environment for the local teams and all of those teams that are in those sites across the globe, that was a challenge for us. We did not know how that would work out. And on paper, but that's our business continuity plan. So we were going into BCP mode like everybody else. But I think the thing we didn't know is how long would that be for. I think, maybe at the time, the worst case scenario I heard was May. People were saying, oh, it's going to be just a couple of months, you'll be back in June. So great, again, with hindsight now to say that, okay, look how naive we were back then, but it was for a prolonged period of time and still is. But at that point in time, our biggest concern was, okay, can we manage all of our systems remotely? Because certainly people have worked from home before. We weren't strangers to that, but how does everybody connect and service and make sure the IT systems do continue to operate flawlessly? Other issues around signatures and things like that, but the IT interlock and making sure everyone's equipment at home was working okay, that was the biggest concern. So all of those questions that we did have ended up to be pretty much concerns that that fell away very, very quickly. And I think we did really, really well in hindsight in staying close to one another. I mentioned maybe yesterday one of the words that kind of have crept into the corporate lexicon was presenteeism, where now the biggest worry that we have is that people are online too often. And maybe it's because it's been very new for people and they feel they have to be online present all the time. So trying to encourage people to take breaks, get away from the PC, do normal things like that. That's been certainly something that we've been trying to do to make sure that people just observe a normal working week. And maybe other things just to kind of keep people connected in terms of not always having the kind of serious official meeting, is to try and mix it up a little bit, have a little bit of fun, mix up the meeting types between phone conversations, video conversations, try and engage people a little bit. So, have kind of quizzes, happy hours, light conversations, that type of thing. I think that's really helped as well. It sounds pretty basic, but I think everyone's tried to build in some sort of informal process into this kind of phone video conference world that we all now live in. And I think the observation we all had was it's not really a business meeting anymore unless you can hear a dog barking or a child crying in the background. That's a challenge that we all face, as well as trying to balance homework and things like that. So it's a new environment. It has shifted, it has changed, and where we are now has moved working from home on about 10 years. When we do get past COVID-19, it does have a real impact now for our global real estate footprint. And, will people all come back to the office? We don't think so. We think certainly there will be that mix of a lot of people will continue to work remotely, and we'll blend that in now with the office changing from a place where you just went to sit at a desk to a place that's primarily going to be used now for collaboration. That's the type of kind of morphing that we see pre, during, and after COVID.
Okay, thanks, John. So Teresa, just in terms of looking to the future, what do you think your key challenges are going to be?
Yeah. So I suppose looking to the future, I suppose from a day-to-day perspective and a team perspective, as John would have mentioned, we found the working from home went well. But I suppose as you look out longer, elements like collaboration and things like signatories become more of a challenge. I suppose we were well set up for working from home from the Irish snow perspective, the couple of days or weeks, but not necessarily for this long period of time. So, there's a few elements that we still need to work out. I suppose from a business perspective, it's still challenging, especially from a food service perspective as we go in and out of lockdowns. And then also, Brexit is looming. So, that's something that we're focused on, and of course will be a challenge as well.
Okay, so just looking at some questions that have come in. Question for Barclays. What was the number one request from clients when faced with the operational challenge of working remotely? Example, digital signatures, etc. So maybe.
Sure, Fiona. Let me answer that. So it's the number one, but maybe let me list a couple of the top ones at least. So as you can imagine, the first one was around digital signature capability. So back to using DocuSign. It's clearly a capability that exists in the banking industry. That was definitely one. The second one, you'd be surprised, actually comes back to more operational treasury, actually. So as you can imagine, as a lot of people started to move from home, you'd be surprised the number of people that had either left the digital authentication devices in the offices, hadn't taken them with them, no longer had access to the main building. So us enabling to get those devices back out to corporate clients, to enable them to authenticate and to continue their day role, that was actually surprisingly one of the biggest challenges we had, but one that we were able to come to. So again, all back to digitization. How do we accelerate it quite quickly? And I think that's been the biggest narrative.
Okay, and also a question in on face-to-face meetings with banks. How do you see this working going forward? Do you see this having an impact?
It's a good question, actually. So I think, like I said earlier, I think the connectivity clearly is all been virtual, as we know, and that has maintained connectivity with the clients. It's very different country by country, I think, to be honest, and it will depend very much based on, one, how the vaccine comes about, secondly, how the governments clearly respond, and of course, the most important we always have to remember, whether it's clients or our own employees, it's really about the health concerns. That's the primary priority, I guess, for all of us. But as you can imagine, all of our bankers want to have face-to-face meetings, as we all talked about. We'd love to be seeing you today. You're in Ireland, not sitting here in my house in southwest London. But I think keeping that relationship is going to be really critical. So, but we're going to have to do it in a phased and measured approach. I think it's not going to suddenly go back to being full face-to-face. And I think to John's earlier point, I think the world has changed actually, and I think and it will continue to change.
Okay, great. Thanks, David. And question for Remco. Remco, what do you see as the challenges for your business going forward?
I think, Fiona, if you have a global perspective, and treasuries that are operating globally, may also recognize this. One is the retrenchment of internationalization. So, we have Brexit on the card that has all sorts of ramifications on, can you still run your cash pool in London? EMIR, do you need to report into trade repositories in London? All of that type of things. And you may need to do your treasury somewhere else as a result of certain developments, sanctions, etc. Second one is technology. Your ability to be nimble plays into technology, and that's one for us as well. We have just taken our treasury management system live to the next version to be able to deal with LIBOR replacement. But things like connectivity for banks is something we want to work on. if you were in this conference 3 years ago, you'll have heard my colleague Lorraine talk about our headaches of changing our European cash management to another bank because the incumbent was retreating. I think, you know, the strategies of banks and your banks may make different strategic decisions as well, which, you know, you need to be nimble for. And lastly, that plays into people. You know, John has talked to different skill sets. If you are working as a team remotely, that requires you to collaborate in a different manner. If you're a manager, how do you motivate and keep your team together? Different skill sets from this situation. So that's how I would sum up, Fiona.
Okay, thanks, Remco. So I think we'll hand back to Mark. I'd like to thank you all for joining, particularly David from London. Thank you very much. So we can hand back to Mark now. Thanks, everybody.
Thanks, Fiona.
Thank you very much, Fiona. Thank you, Remco, John, Teresa, and particularly David Shinkins, and our kind sponsors, Barclay. Now, to quote one of Joe Biden's more famous comments in the wake of the recent US presidential election, let's get back in the game. Our exhibitors and their representatives are waiting for you in the exhibition area. And to incentivize your participation, the Irish Association of Corporate Treasurers are doubling the money for every point you notch up, and you notch up more points by making more connections with the booths. And every time you make a connection, you get a quick, fun quiz, multiple choice to identify a superhero. And if you get it right, you get a code. And if you get the code, you go to the leaderboard and enter it, and you get 25 points. And the winner is the company or person that gets the most points, and you will get to decide which of 3 charities the total amount notched up at the end will go to. And the 3 charities are Bernardo's, the Jack and Jill Foundation, or Barrettstown. So get busy with your mouse pads, and we will see you back in approximately 10 minutes. back, everybody. Hopefully you got some time to connect again with our exhibitors and raise a bit of money for a good cause. And you'll have another chance to do that later on. Let me just say that so far in the lead is it Cian Butler from ESB Training. Well done, Cian. Keep it up. And the rest of you might try and catch up with Cian. He's well ahead on 200 points. Now, like no year before, this year, 2020, has been a year in which digital transformation and digital innovation affected the global economy and the corporate world. Here now to discuss that with me and how it has helped companies through these very challenging times, I'm delighted to be joined by the Head of Payments and Solutions at JP Morgan, who are our kind sponsors today, and that is Sarah Castellano. Sarah, you're very welcome, and the floor is yours.
Excellent. Thank you. And thinking about this, actually, my last flight of 2020 was from Dublin to the UK after the IATC breakfast that morning. I cannot believe that that was probably the last time we're going to give handshakes to each other, and what was in store a couple weeks after I left Ireland. But it was quite timely because I was there in February talking about initiatives around how to think about direct to consumer and leveraging new technologies where possible. And what we've seen is COVID has completely accelerated those conversations. And I'm absolutely grateful that you've invited me back, socially distanced all the way here from London. And I want to applaud absolutely all of our corporate treasurers, because what we saw with COVID is that it also really helped highlight the importance of Treasury and its strategic involvement, particularly in liquidity and managing risk. And during this time period, I love thinking about, people are saying, yeah, we're all working from home and our staff is working from home, but we're not. We are trying to work from home during a global pandemic. And I think that as an industry, we've really done a really great job. We've seen great, exciting things happening with our corporate clients. And as banks, we've all come together really to make money move, although people have all completely basically come to a halt. My presentation today is really about capitalizing on payment opportunities in the new norm. Great to see the poll earlier stating that payments are on the top of your list. So with that, I'll move on to the first slide. Outlined in the panel before, and what we are living on a day-to-day basis, is that COVID has caused a systemic disruption to absolutely everything we've done. And that's all the way down from us as individual consumers and consumer behavior around the way that they're purchasing goods. We heard on the panel before the rise of contactless payments, but it's also new business models. Myself, I used to go to the grocery store every week. Now I'm ordering my groceries completely on e-commerce on an online platform. And what we've seen as a market, e-commerce has just completely taken off, and having that focus on direct to consumer and understanding your e-commerce strategy is so important. All of this was taking place while supply chains globally were essentially reevaluating and almost in some places coming to a complete halt. And what it became is that focus on adjusting to that is becoming critical, because all this was happening, and we heard it earlier around March, April, and then we see again last month with everything around the US elections. It's really been a time for corporates to really start focusing on how to deal with this disruption. Moving to the next slide. What this has done is really also magnitude everything for Treasury, like signing documents, paper processing, signature cards. We heard from the panel before how that was so difficult. But also, one of the things that we've seen is information around MIS becomes even more critical. And in a pre-March conversation, we were all talking about the difficulties of cash flow forecasting and the data we could get and really help get balanced information. And that is unbelievable because it's still a problem, and it's absolutely been magnitude even more, given the fact that at any moment's time, asks are coming from across organizations saying, I need to understand, and getting that data becomes extremely hard. All of this underpinned by the risks and controls needing to continue to be available while you're working from home. Cybersecurity, and what we saw during this time period, and we still see today, is unfortunately the criminals are smart and they essentially prey on disruption and vulnerabilities, and that became such a big focus for our clients and us as a firm as we've started to navigate this work from home basis. And it really continues to be a priority, as we're unlikely to ever return to the office in a full environment. I absolutely agree with before around collaboration in the office versus necessarily working on it. So setting the scene, we know there's a lot that's happened. We've been doing the best that we can, but there's still some fundamentals that we really need to work through. So moving on to the next slide, I'd like to focus on essentially breaking it down into how to leverage digital information in three major ways: safeguarding the core, sustaining operational continuity, and building for the future. So the today, the tactical, and then the long term. If I think about safeguarding the core, now protecting your business, I love the term that we're trying to fly the plane whilst we're still fueling it. Existing processes need to be reviewed, but controls need to remain. In order to achieve this, focusing on visibility and access to information real time actually becomes critical. We had a huge amount of conversations throughout 2019 with clients that were saying, I don't really need to know my information real time. I'm still okay with my end of day statement and protecting my cash runs. Everything in my business is quite predictable. Now, that I swear was a jinx, because now we know nothing's predictable and we can't have reliance on end of day statements anymore. Having the ability to really get visibility of cash becomes even more important, and visibility of cash leads to control, and control enables to make smarter decisions. And especially in this environment when everyone's trying to really understand cash positionings and really understand how they can maximize leverage of their money to either pay down debt or go back and invest in their processes. The crisis also really put a new focus on technology. We had been having conversations around APIs and machine learning and artificial intelligence.
And that question will bring us to
sorry, Mark, I'm okay. No worries. So what is actually done is we've been talking about these technologies for a really long time, but what happened is we've accelerated those conversations. APIs have become a reality. 18 months ago, we were talking to clients saying, we should be talking about APIs, we can help you, and the dialogue has changed. The dialogue has changed from, okay, APIs are not just a concept, APIs are a reality for us. And it's a two-way conversation. It's not a conversation where we're saying, here's an API, can you use it? The conversation has shifted to, I need this is my problem in Treasury, and how can I build to that? And one of the things that we built over the last year is an API plugin into Excel, because Excel still is so important in treasury processes, and leveraging Excel at the office when you have 2 monitors and you're all set up, that's something that you can manage, although still not the most easy process. But when we saw that moving from home, working on a small iPad or trying to work on a laptop, navigating Excel became extremely difficult. So building into Excel through our client's own ecosystem, that connection via API from our systems enabled them to get better visibility of their cash. And that not only was helpful, but that was something, because of the nature of APIs, we could implement in a very short period of time. Of one example where we were able to actually turn it around in 9 days. And that's so remarkable when it comes to what we're doing. And open banking becomes more of a reality in today's with thinking about account validation and making sure that you're working from home. You can't just go and say to your colleague next to you, oh, can you just verify this thing for me? Where you can actually go in an API and get account validations. And that's been so important to making sure that your today process is working to safeguard your business. Now, if we think about sustaining the operational continuity, it's about on the edge processes, looking at shared service centers and really seeing where we can start establishing a standard process and become a BAU. I love that the industry has all significantly moved to leveraging tools like DocuSign. That's an industry utility, and Barclays earlier before stating how they're leveraging DocuSign for their customers, JP Morgan were doing the same. That really starts getting to the point around signature cards and how difficult it is to sign documents. Over this period, we've seen so many more clients sign up to leverage e-signatures, and that's globally. I manage multiple countries, and especially in the Middle East, where a lot of the processes to date have been very focused on actual signatures, but magically overnight, we've been able to put huge amounts of digital documents into that end-to-end process. So one of the things we've been talking to our clients about is actually introduction of electronic signatures as the standard process and wedding signature as the exception. Really kind of changing the thought process around how you're looking at your shared service centers and looking at your operational flows to really enable the best kind of output. The other thing that I found was very important is phone calls. Our client service team has spent a lot of time with phone calls, and most of those calls are, where is my money? So over the time, we've built out a payment tracker where anyone can go online and track out transactions. Now, that was something that we as a firm decided not to put in through our pilot standard development. We actually put it in our whole entire system as beta. And we said, look, everyone try it, see how it works. And we continue to build leveraging machine learning. The last point here around building for the future, I speak a lot about new technologies, and we did a recent survey with our clients around Euro finance, and we're finding that majority of our corporate treasurer clients are still not using machine learning and artificial intelligence in their processes. The more machine learning and artificial intelligence is very important, because the more systems can learn from past patterns, the better they can predict things in the future. Now, there's a huge amount of uncertainty out there, but starting to get better visibility for cash flow forecasting using machine learning and artificial intelligence becomes extremely critical and something to focus on and learn from as you're thinking about your processes into the future. And just to sum it up, moving to the last slide, as companies are navigating the new norm, I think it's extremely important to automate processes, think about data real time as an asset, strategic partners to business, so companies like banks that are leveraging external parties and really looking at the systemic ecosystem of corporate treasurers so that we're making bank agnostic solutions like DocuSign. and really thinking about the digital capabilities and payments. How important is it that you have digital in your payments processing? And then the last one is really innovation ecosystems. So thinking about things like your process and how can your bank help with your process. The example I gave on Excel was a client coming to us saying, we use Excel a lot, we put the API in there, and now we've rolled out an API Excel plugin across the ecosystem, because I think it's extremely important for you as treasurers to really think about your own ecosystem and partner with companies that can help develop in your ecosystem, because that's really how we set up for the future. I'd like to take this opportunity to also challenge you to think about your processes, and with that, we can open up for questions. Back to you, Mark.
Thank you very much, Sarah, for some really great cutting edge insights. And we do have a number of great questions coming in from our audience. I can't throw all of them at you, but in the 4 or 5 minutes that we have remaining, maybe what I will do is I will give you 3 of them in sequence together, and you can take them as you wish. So I suppose the first question would be a summary bullet point of how many of the changes in payments are here to stay, and how many are cases where we'll see things going back to normal when the crisis subsides. That's the first question. The second question is, do you think cybersecurity has caught up with the changes of the last 8 months? And the third question would be, have you experienced the difficulty of new digital innovation systems trying to interact with legacy systems? And can you give us some insights on that?
Yes, so coming at me, I'm hoping that a lot of the trends that we've seen are here to stay. I have zero interest in putting more paper into the ecosystem. So the decline of paper when it comes to physical checks is important. The decline of paper when it comes to signing documents is important. And as we heard earlier, ESG is important, and the least amount of paper we have in the ecosystem, the better we're all doing for the wider world. So I really believe those things should absolutely continue to go digital. Leveraging technology like API should also continue, and I think that this is just the beginning. APIs have been along in the wider world for decades. They've just come into the banking and corporate ecosystem recently. I think we're seeing a huge amount of focus on it, and partnering with key ERP providers, we've been also able to kind of think about how does bank technology interact with corporate technology. And yes, you might not be on the latest version of SAP, but how can you leverage some of the technologies in your current ecosystem? So I think that leveraging these new technologies will help us in the future. I hope that we get back into the office and we can collaborate better, because I fundamentally think there is a real thing called Zoom fatigue. I believe it. I feel it every day. And I spent a couple of months in the office over the summer, and I really loved being back with my team and brainstorming and whiteboarding. It's not the same at home. So I really hope that does come back, and going and talking to clients, I think, is still important, although I'm not sure any of us will shake each other's hands. When it comes to cybersecurity, I think the criminals are absolutely billion-dollar funded institutions, and they're things that you absolutely need to constantly stay ahead of. At JP Morgan, we've spent upwards of $1 billion just on protecting our firm and our clients. But what we've seen is, especially some of the tools that we built a couple years ago actually come into fruition and support our clients over the last couple of months. So one of the things we've done is we take all of our payments data and we send it into one payment data lake. And from that, we are able to apply machine learning to identify patterns in our clients. So if you've never sent a transaction to the Philippines and all of a sudden you send a transaction to the Philippines, it will flag up in our systems. That's been really helpful over the last couple of months because that's a process that already runs. Where we've gotten smarter and working, especially here in the UK with confirmation of payee, is working as an industry to validate account numbers, because invoice fraud is still a real thing. And I honestly believe that if we can validate account numbers and match that Mark Coleman matches his account, I think that will help systemically reduce this. And that's something we've been very active in working on and getting our bank clients to do that, because if our banks can do it, our corporates can benefit from it. And I think that all as a community, we need to work together to fight cybercrime as a whole.
Sarah, thank you very much. Sarah Castellano there, Head of Payments and Solutions with JP Morgan, joining us from London, and we do hope you get to fly back to Dublin in the near future. We'd be delighted to see you again. And thanks also to JP Morgan, our very kind sponsor of this event. Now, folks, it's about time that we had some quality time with our exhibitors and networkers. Our previous two breakout sessions were 10 minutes apiece. We're going to give you 20 minutes this time. So let me remind you how it works. IACT have kindly put up money to donate to 3 children's charities. They are the Jack and Jill Foundation, Bernardo's, and Barrettstown. And to be in with a chance to win a €150 voucher for wine and chocolates, and to decide which of those charities gets the accumulated money, what you have to do is connect with as many exhibitor booths as you possibly can. Each time you do, you'll be asked a multiple choice question to guess the identity of a superhero. If you get it right, you get a code. You put the code into the leaderboard, and the more points you clock up, the better. And IACT will double your points, and we hope to announce the winner at the end of the event. And I can say that Cian Butler of ESB Treasury is still well ahead on 200 points. So the rest of you are going to have to try a bit harder to catch up there with Cian, and well done him. We will see you back in 20 minutes. Welcome back, everybody. We hope you enjoyed the networking session and you racked up a few more points for our children's charities. And I have to tell you, we're going to have to keep the lines open. We have a very exciting situation on that front. In joint first place, we have 4 people. We have Cian Butler of ESB Treasury, who is in the lead for a long time, but has now been joined by John James Dunn of Grafton Group, Yvette Quain of Wells Fargo, and Catherine O'Brien at Treasury Consultants, and a couple of others coming up behind. I feel like I'm narrating the Punchestown race meeting here. And another little bit of housekeeping is that we want you as the valued customer to tell us what you think of the event overall. And to that end, we have a little question at the bottom left-hand corner of your screen where you can go in and tell us your level of satisfaction with the event so that we can make it as good as it should be. Now, we have had a very, very momentous year. We have had a general election in February, which broke the mold of Irish politics established over 100 years beforehand. We have, of course, had the COVID crisis, and we've had and may yet have more momentous events in the United States with huge implications and ramifications for the rest of the world. Our keynote speaker is eminently qualified to give us a view on all of these issues. He is a former General Secretary of the Labour Party. He is a former CEO of Barnardo's. He is also a columnist with The Examiner. So I'm delighted to welcome Fergus Finlay. Fergus, thank you for joining us, and the floor is now yours.
Mark, thank you very much, and I'm delighted to be here. I have to, unfortunately, start with a confession. I was a good student, a long time ago, but I was a good student, and I did very well in all my exams. The exam I ever failed was first year accountancy in UCC. And I failed it so badly that I promptly switched to public administration and sociology to get as far away from accountancy as I could. I ran organizations all my life, and I had to present balance sheets all my life. And I still struggle with the notion that if somebody owes me money, it's an asset, and I have to think of it as an asset. And if I owed them money and I haven't been forced to pay it, it still remains a liability. So I'm intuitively probably the worst possible person to speak to treasurers and financial managers. I listened with rapt attention to Sarah Castellano 20 minutes ago, and I thought she was absolutely fascinating, and I thought she came across as somebody who was really on top of her job, and I barely understood a word of it. So please don't expect me to answer any deep technical questions about the work you do. But the reason I was tempted when I was originally asked to speak to you is because I've worked with people who do what you do for years and years. In fact, my life has been saved several times by directors of finance and financial controllers. I've uncovered in my time 2 very significant frauds and 1 piece of very, very incompetent financial management. And the only reason I was able to uncover them is because I was able to ask stupid questions to very patient people who guided me through it. So I really value the work of anyone who works in the financial area, particularly on the management side of it. What I thought I would do, if you wouldn't mind, Mark, and I'm probably going to segue away a little bit from just the current year. You can't ask a 70-year-old to speak to a gathering like this without relying on the 70-year-old to wander back a bit in time. I want to talk about leadership, and I want to do it by telling you some of the people who have influenced me most over the years. And I'm going to start with a man that very, very few of you, unless you're of a vintage like mine, would even remember. A man called Dennis Larkin, who was the son of Big Jim Larkin, who led the 1913 lockout in Dublin and was a leading trade unionist in his day. Dennis was famous for being disorganized. He was my first boss. He was famous for being so famous for being disorganized that you were warned if you went to his office, do not bring paper with you, because the paper would be lodged at his desk and would be lost. And about every 3 months, the two caretakers in the building that we worked in, which is in Parnell Square, would go up to Dennis's office, spread a huge tarpaulin on the floor, sweep every bit of paper off his desk, carry it down to the back garden and put a light to it. And then he would start accumulating paper all over again. So he wasn't a man who inspired leadership in any of those ways. But the first time I met Dennis Larkin as a boss, I had just been through one of the most wrenching weeks of my life. My first child was born. This is a long, long time ago. My daughter is 47 now, very strong, independent woman. She was born with Down syndrome, and it was a really, really difficult time. These were not times when we even knew what Down syndrome meant. And my wife rejected her. She found it really difficult to cope with Mandy's arrival. She was born on a Saturday, and I was due to start my day job in what was then called the Workers' Union of Ireland on the following Monday. I went in on the Monday morning and I said to Dennis Larkin, Mr. Larkin, I'm very sorry, I cannot start today. And he said, why can't you start today? And I said, because I had a daughter born the weekend. She was born with an intellectual disability. We're struggling to cope. We need time to cope. So I will not be starting for a fortnight. And he said, I'm sorry, you have to start. We've committed, we've got a contract for you, you've got to start today. And I said, no, you don't understand, Mr. Larkin. You really don't. And he said, look, that's a situation, but you got to start work. And I stood up, I knocked the chair back, and I said, if that's your attitude, Mr. Larkin, you can shove your bloody job. And I turned and walked out the door, and he called me back from the door. And when I turned around, he had a big grin in his face. He sat me down. He had a big old-fashioned checkbook in his hand. And he said, you're starting today. You're taking that wife of yours on 2 weeks holidays, and here's 2 weeks pay. And he wrote out a check for the equivalent of 2 weeks pay. Actually, he wrote out a check for the equivalent of 2 weeks gross pay. And I don't know if that was ever reconciled with the taxman. From that moment on, you could never, ever hear a bad word from me or say a bad word about Dennis Larkin in my presence. Decency, which was his hallmark, was the thing that inspired astonishing loyalty in me all my life. And I don't know that I have ever met a man whose only quality of leadership, is really his only quality of leadership, was the strength of his conviction and his innate decency. But I would follow him anywhere, and so would anyone who ever worked with him. I went on to work with an awful lot of other men, some of whom I liked and some of whom I didn't like. I worked for a long time, for example, with the late Dr. Gareth Fitzgerald, who was Taoiseach in a government in which I was Deputy Press Secretary. And again, he was a man you would follow anywhere, but he had none of the qualities of leadership, except, again, very innate decency, very strong sense of vision. He was another man who was utterly and completely disorganized rather. Cabinet meetings in those days would take 12 hours. Cabinet members would totter out pale and exhausted at the end of their cabinet meetings and wouldn't have the faintest idea what they had been discussing for the first 5 hours of the meeting, as a consequence of which terrible political mistakes were made. Poor management of meetings led him into situations where mistakes were endless. And the reason the management was poor was because Gareth wanted to get into every tiny bit of detail. The famous expression, and it was a true expression attributed to Gareth Fitzgerald, was, I know it works in practice, but will it work in theory? And you had to explain everything in word one syllable. When he got stuck into stuff, he got things done. But the overarching thing about him, the thing that people adored and loved and followed about him was that overriding sense of vision, which more than compensated for the lack of management ability. I learned from him that you can be a leader without being a manager. And I was told many years later by my colleagues in Bernardo's that although I was a crap manager, and that was, I'm afraid, the term they used, I did perhaps have some of the instincts of leadership. And if I learned them from anyone, I learned them from him. In the course of that time, I also worked with Des O'Malley, who was a man who was prickly, difficult, awkward. And you might find it hard to figure out how anyone would follow him, but he was a man of incredible character and guts and courage. He took on any vested interest that he felt he had to take on, and when he did, he never flinched. He never took a step back. He took on some of the most powerful commercial interests in Ireland, some of the most powerful political interests in Ireland, and he sacrificed an awful lot. He's often described as the best leader Fianna Fáil never had. He would have undoubtedly been a Taoiseach in Ireland if he had been willing to compromise at the level of principle. So from him, I learned the importance of character. If you have character, then it makes up for an awful lot. One of his great enemies, for want of a better word, was Albert Reynolds. And I had the great honor and pleasure of working with Albert Reynolds in the mid-90s. Now, Albert and I never got on. In fact, for years afterwards, as long as Albert was alive, if I put the words Albert and Reynolds into a sentence, I was almost guaranteed to get a solicitor's letter. No matter what I said, Albert Reynolds and a cup of coffee would guarantee me a solicitor letter. He thought always to do it, and there's a long and complicated story about how I ended up getting blamed for his departure from office. But I sat with Albert Reynolds twice when he was negotiating with effectively the IRA. He was negotiating at a slight move with the IRA about the question of whether or not they would bring an end to violence in Northern Ireland. He got close, it receded, he got close again, it receded. And then there were a couple of crucial days, which were the make and break days in that process. And if he got the ceasefire, then it would make his place in history. And I thought, because Albert was famous as a deal maker and a negotiator and all that, I thought that he would compromise for the sake of the deal, the laying down of the arms. Not a bit of it, not an absolute bit of it. He was confronted at one point in a meeting by a suggestion that all guns would be laid down except those needed for defensive purposes. And his answer to that was, if you're not at war, you don't need to defend yourself. No guns, full stop. Look, he was told, it's much more subtle, it's much more complicated. He said, I want it in words that a primary school child would understand. If you're putting down your guns, you're putting down your guns. He never flinched about the single greatest objective of his political career. He wanted it, but he wanted it in ways that you couldn't weasel out of thereafter. And he confounded me, I have to say, because I thought, this is a man who's going to compromise. But compromise was fine up to the point of principle. When he got to the point of principle, Albert never compromised. And from him, I learned the lesson that principle is the only thing you can't compromise about. If you are negotiating about anything, you're negotiating to try and reconcile your interests with the other guy's interests. You can't negotiate to reconcile your principles with the other guy's principles. Principles are non-negotiable. That was Albert's view of the world, and it was something that he taught me. Along the way, as part of my dealings with Albert, I was given a slightly odd trust by that government. I was allowed to be the person who had the first engagement, as it were, with loyalist paramilitaries in Northern Ireland. And that led me to a meeting, one of a number of meetings, with a man called Gusty Spence. Now, again, none of you will remember Gusty Spence, But his place in history is defined by the fact that he was the first Protestant in Northern Ireland to be sent to jail for killing a Catholic. And there is an image, if you Google Gusty Spence and go back to 1966, I think it was, when he was first sent to jail, there is an image of Gusty Spence with a woolen hat on, lantern jaw, cradling a huge big machine gun in his arms, big military sweater and so on, looking as tough as it is possible to get. And that was the image in my head when the day I was told I was going to meet Gusty Spence. And I don't think I have ever been as apprehensive about a meeting as I was about that one. And I walked into that meeting to meet my granddad. He was twinkly-eyed, he was sitting there, he was puffing on a pipe. All the 30 years ago of violence had gone. He'd served his time, he'd learned along the way that violence solves no problem. He'd educated himself, and he'd educated a host of young men around him. People like David Irvine and Billy Hutchinson, they were the ones who led the Loyalists away from violence, not for tactical reasons, and that was the difference between them and the IRA, for principal reasons. They came to the conclusion that all violence does is hurt people. It doesn't solve problems. And he was a man who taught me in his own journey and in the things he did and in the things he said, and in his humor. He taught me an awful lot about the need to be open-minded, the need to be willing to learn from others, the need to listen. All great communicators are great listeners. And in my experience, Gusty Spence was one of the all-time greats. The two final groups of people I want to tell you. First of all, I want to tell you about the Women in Barnardo's. And Women in Barnardo's is a very odd thing. I'm not plugging the charity, okay? If you want to contribute to Barnardo's, brilliant, but I'm not plugging it. The funny thing about Barnardo's, there were 400 of us in Barnardo's. About 370 of them were women when I started. I was kind of a token man, although I was the CEO. And I was surrounded by women who were younger than me, better looking than me, and much more able than me. Every day they taught me something. They absolutely taught me something about how to care, what care means, about how to behave, what behavior means, about how to change, and what change means. Every single day. I could be here for the next 20 minutes giving you examples of things, but I'll give you one. A number of years ago, I at this time of year every year, I take down from my attic a huge red suit with a great big beard, hat, wig, and everything that I bought a number of years ago. It's a top of the range suit, and it enables me to go around impersonating a certain chap who is very busy in the month of December and in the run up to Christmas. I often joke that when I bought the suit, because it was top of the range, the box came full of padding, which I've never needed. The padding has just rotted away in the box. I use the suit, but my own padding fills it out. But I was impersonating in a very disadvantaged community in a Barnardo's project. I was impersonating the man in the red suit for a group of kids, and we had a wonderful time. And before I went out to my sleigh in the back garden, the kids stood around a circle and decided that they wanted to sing Santa Claus a song. And the song they sang was Twinkle, Twinkle, Little Star. They were 5 and 6, these kids. All except one boy who stood with his hands hanging and his head facing the floor because he just refused to sing. And I thought I'd done something wrong. I thought I upset him in some way. And I was asking the manager of the centre why he wouldn't sing. And she said, well, he doesn't know the words. He just doesn't know the words. And that blew me away, because in all my life, I have never met a 6-year-old who doesn't know the words of Twinkle, Twinkle, Little Star. And she explained that he came from a house where no hugs at bedtime ever existed, no storytelling at bedtime ever existed, no songs were ever sung to the kids. And she showed me, we talked at length about this, and she showed me the link between that childhood experience and the certainty that that kid if that wasn't addressed, that kid would have his first bit of antisocial behavior at about 12, his first brush with the law at the age of 14, that the absolute certainty that a child who never got a hug, never got a bedtime story, never got a song sung to him or learned the words of a song at that age would end up with a highly dysfunctional life and a highly dysfunctional adulthood. I went back a year later and he was the loudest voice in the choir. And he was the loudest voice in the choir because they had spent a solid year working with that entire family and addressing those gaps. Not just teaching them the words, obviously, but he was now a kid who went home to a house where there were cuddles and where there were smiles and where other problems were beginning to be addressed. That's what the women of Barnardo's did. They were content always to let me wander around taking credit for their work and telling the story. But their leadership was the thing that probably taught me more than anything else about leadership. The final person I wanted to mention is Rudy Giuliani. And this will sound a bit odd, because I think Rudy Giuliani, in some senses, is a crackpot. In many senses, I think he's a crackpot. But I met him, believe it or not, in 2003, a couple of years after 2001, after 9/11. And we all remember, I suppose, what he did in 9/11 and how he led his people through that crisis. He wrote a book about leadership, and he spoke about leadership at a meeting I was at, and there was a dinner afterwards, and there was quite a bit of chat and so on. And he was a man of incredible common sense, straightforwardness, and so on. His attributes of leadership, which I've always thought came across in some of the people I've met, his attributes in that book were 6. I've paraphrased them slightly. He lived by these dictums at the time, although I don't know what has happened to him since. He's clearly been influenced by his friends. First, you have to have conviction. Second, you need to be an optimist. I can imagine in the last 6 months, optimism has been in short supply in your business. Thirdly, you have to be prepared to take risks. He used to talk about that as courage. I tend to think of that more as character. Fourthly, he insists always, as a prerequisite of leadership, on relentless preparation, an absolute refusal ever to take anything for granted. I always thought that was an odd thing, coming from a man who rose to fame and rose to prominence by his instinctive reactions to 2 planes flying into the Twin Towers in New York. Fifth, he said, teamwork is essential, springing from the ability to inspire trust. And finally, he talked about the need for leaders to communicate. He communicated at length. He was never then, and I don't think is today, a good listener. My addition to his 6 principles is the importance of listening. And the final thing I want to say to you is a word that he never used and that I never kind of came across, but it gradually, as I got older and older, got borne in on me as the fundamental bottom line prerequisite of a leader, and that's respect. You got to respect yourself, you got to respect the people you work with, and you should never work with people you don't respect. That's all I wanted to say to you, and I'm very grateful. Now I think you should get back as quickly as you possibly can to the much more interesting, if slightly arcane, world of high finance.
Fergus, thank you so much. It's a world where we celebrate diversity in the corporate world, and it's not just about gender diversity, but it's also about diversity of perspective. And we have been talking about numbers and number crunching and finance all morning long, and what we really needed was a reminder that when the numbers are crunched and analyzed and processed, at the end of the day, it's character and integrity and leadership that makes the difference between failure and success. And you have brought that perspective better than anybody could have done so. And I'm sure that I speak for all of the membership of the Irish Association of Corporate Treasurers when we expressed our heartfelt gratitude for the richness and the wealth of the perspectives that you have brought to us. So thank you,
thank you
very, very, very much indeed.
Thank you very much.
And now let me tell you that in terms of something close to your heart, Fergus, we now have 5 runners in the lead for top of the league. Cian Butler, VSB Treasury, John James Dunn of Grafton Group, Yvette Quain of Wells Fargo, Catherine O'Brien, Treasury Consultant, and coming up on the inside, Patrick Corkery of Van Fleet. So I'm afraid the situation is so competitive, which is good news. We're going to raise more money than we thought for the children's charity. We are going to have to defer the announcement of the results until tomorrow, and we're going to keep the lines open. So keep your clicks coming in, and we hope that tomorrow we will.
Mark, I don't want to interrupt, but they're telling me to get off. I think that's wonderful. I think that's fantastic and brilliant. The only thing I would say is I think Cian's boss should probably ask a couple of questions about his obsession with superheroes, which is clearly helping to be doing.
Well, there might be more than one obsession there, but we'll see. We'll let it run anyway.
Thank you very much.
We look forward to a great result tomorrow. And thank you, Fergus, for joining us.
Thanks a million, Mark. Thanks.
Now, ladies and gentlemen, it's my great pleasure to introduce or reintroduce to you to formally close the ceremony today, or the event today. It's been a great event, and it's thanks to, we're talking about leadership, it's thanks to the leadership of your president, Kevin Daly. Kevin, the floor is yours.
Hi everyone again. Yeah, I would just like to echo what Mark just said and thank Fergus. I didn't know what Fergus was going to talk about, but I know he said Treasury, corporate finance wasn't his thing, but I think he touched on something that's that glues it all together. That's much more important, and Mark covered it as well, which is basically leadership, which comes in different forms. And the words I wrote down here were decency, relationships, and generosity. I think when everything is taken away, the way we used to work and the way we used to interact, it all comes back down to personal relationships. And I thank Fergus for sharing his experience and insights with different types of leaders. And as he said himself, he mightn't necessarily agree with everybody, but everybody brings something to the table. So I really enjoyed Fergus's talk this morning. I would just sincerely like to thank all the speakers and presenters and the panelists this morning. We really appreciate your time and that enabled the conference to go ahead this year. It was very challenging for everybody this year, as I said this morning, personally and professionally. But the thing that struck me, not just in the conference but throughout the year, was people's generosity with their time, was their willingness to volunteer and give generously with their time and their efforts. I would also like to thank the sponsors this morning again: HSBC, Barclays, and JP Morgan, the exhibitors, Amundi, Aviva Investors, Deloitte, ICD, International Cash Distributors, Kariba, Morgan Stanley, and Salmon Software. the conference this morning would not have gone ahead, and I'd like to thank, without the help of and the leadership of Mary Griffin and the team at Summit Focus, who showed great flexibility and commitment right throughout this year. I mean, the situation evolved right throughout the year. You know, we were looking at putting on the conference, not putting on the conference, being able to do it physically, not being able to do it physically. So it was continuously changing, but Mary and the team showed great flexibility in working with the IACT. I would also like to thank the full IACT committee for all their time and commitment this year. The committee devotes a significant amount of time of their time to committee meetings, organising webinars, and the various events and initiatives that we put on for members. Many of them taking this different forms this year. I would also like to thank our patrons and you, the members, for making the IACT possible and sustainable over many years and into the future. And hopefully at some point we will be able to meet face to face in 2021. Finally, and by no means least, I would like to thank Mark for chairing the conference this morning. It was a different format, but it's run really, really efficiently. And I would like to thank Mark for making sure that happened. Thank you, Mark. Finally, I'd just like to say I hope everyone is able to enjoy Christmas this year, which again will be slightly different. Hopefully things will loosen up a little bit, and people can enjoy the break this year, because I think this year, never more than previous years, has people deserved the break, and hopefully as we look into 21, there'll be more optimism ahead, and things will return to some type of normality sometime during the year. So thanks again. I'd just like to hand back to Mark now. Thank you.
Thank you, Kevin, and thank you for the invitation to chair the event. It was an absolute pleasure, and it was made a lot easier by Summit Focus and CrowdComms, who provided fantastic support. I think that Kevin has comprehensively thanked everybody who needs to be thanked in terms of the sponsors and the organisers. So I will repeat my thanks to the sponsors, HSBC, Barclays and JP Morgan. I will add thanks to James Pomeroy, Sarah Castellano, and particularly Fergus Finlay for a real tour de force finale. But we're not done yet. We are going to keep the lines open for the charity quiz, so keep your votes coming in, or your answers and questions coming in. We'll announce that tomorrow. And we are now going to go into 3 breakout discussion rooms on 3 distinct topics. They are a corporate case study of Publicis Treasury, and we're going to have Keith Lynch, Treasury consultant with KPMG, and Meindert de Vries, international treasurer with Publicis Group. I hope I pronounced that name correctly. The second session is Sonia, Foreign Exchange and LIBOR Transitioning, where we will have Jason Murphy, CEO of Centris Advisors, Sean Kennedy, Group Treasurer of Associated British Ports, and Kieran Corbally, Corporate Treasury Director of Price Waterhouse Coopers. Finally, we had hoped that Peter Berger and Pascal Saint-Amand could join us live to discuss international tax landscape. The little bit of bad news is that they could not join us live right now. The good news is we did catch up with them earlier, so you will see a pre-recorded working group. How do you get into them? Well, you simply go to the screen and click on the breakout session that interests you the most, and I think you may be able to have 2 or 3 of them on the go at the same time, depending on how many laptops you have, and just click on join here, and we encourage you to engage as much as you can. And I believe Peter Berger is actually live with us, although the element with Pascal Saint-Amand is pre-recorded. So thank you, everybody, and congratulations also to the participants for their questions and their engagement. I believe it's been a very successful event, and I think we can look forward to another great event next year, hopefully in our physical form rather than virtual. And don't forget to tell us what you thought of the day's event. Tell us how you rated the summit. There's a little tab on the bottom left-hand corner of your screen, And we look forward to your thoughts on that. And we will take them on board to make next year's event even better than this year. Have a good day, and thank you again for inviting me to host.